The Federal Reserve recently reduced the rate hike to 25 basis points, which indicates that the era of high interest rate increases may be coming to a close. This is due to mass layoffs putting downward pressure on the employment rate, a decrease in home buying demand, and declining inflation resulting from weak retail sales. Some Fed officials predict that interest rates could soon be lowered, while others believe that this is just the beginning with potential for significant harm. It is important to discuss the Federal Reserve's warnings in the coming months and consider what actions can be taken in response. This change in rate hike policy could potentially lead to a new trajectory in the economy, not seen in over a decade. However, it's important to note that this change in direction could be impacted by the Fed's future decisions regarding interest rates. Before discussing the Federal Reserve's recent rate hike and their 2023 warning, it's important to understand the current state of the market. The Fed has been actively increasing interest rates to curb inflation, but their accuracy in doing so has been called into question. Initially, the target federal funds rate was expected to be around 1.9% by the end of 2022, but it has since been adjusted to 5% with the goal of reaching that level in the coming months. Despite this, inflation has been decreasing over the last 6 months, dropping from 9% in June 2022 to 6.5% currently. Additionally, companies are downsizing their workforce, which is negative for the middle class but positive for Jerome Powell, as it indicates that wage gains are slowing down. Be sure to like and subscribe for more content. The general idea is that when job growth is strong, employees make more money, which leads to increased consumer spending and higher prices. In 2023, bad news is considered good news because it reduces the likelihood of higher interest rates. The latest consumer spending report showed a decline of 0.2% month-over-month, which gives the Federal Reserve more reason to believe that the economy is slowing down. As for the housing market, luxury home sales above $5 million in areas like San Francisco have declined 70% in the last year. All homes are taking longer to sell, and the total housing inventory has fallen under 1 million units, with growth slowing down from the previous year. According to Zillow's report, the biggest deterrent for buyers currently is the high cost of housing, with a typical home now costing 62% more per month than it did at the end of 2021. According to the latest data, the biggest month-over-month housing decline was seen since 2011, with buyers and sellers still uncertain about the market. 52.9% of the available homes were sold for less than their asking price, similar to what was observed in July of 2020. Although real estate markets vary, Minneapolis saw the largest decline, with Oklahoma City, Phoenix, and Houston following closely behind. However, some areas like Salt Lake City, Raleigh, Indianapolis, Cleveland, and Nashville have seen a significant increase. The pending home sale index is considered a leading indicator for the market's direction and is something to keep an eye on in the future. In December of 2022, the housing market saw a slight increase of 2.5% from the previous month's record lows. Meanwhile, the stock market saw an increase due to the optimism surrounding the Fed's interest rate hike and expectations of China's reopening economy driving demand and boosting international trade. However, some experts warn that China's increased demand for energy and raw materials may lead to higher inflation, which could result in the Fed having to raise interest rates higher and for a longer duration than expected. The president of the Swiss-Chinese Chamber of Commerce even stated that China's energy and raw material needs will compete with European and global needs. While inflation may appear to be relaxing now, it is expected to see more pressure in the third quarter. Michael Burry previously warned of this possibility. Statistics show that inflation does not disappear after appearing in spikes. Instead, it subsides temporarily, and people start spending more money, leading to its reappearance for a decade or more. An analysis conducted post-World War II revealed that it took several years for inflation to normalize from its peak, and it never stabilized within a few months. The current situation with the Federal Reserve and rate hikes is seen as positive, but the long-term impact is yet to be determined. The average analyst predicts that the S&P 500 will end the year at 4,000, with a range of 3,500 to 4,500. A record amount of cash is waiting to be invested in stocks in case of a decline. The recent 25 basis point rate hike by the Fed has already been priced into the market and is not a surprise with inflation slowing down. Currently, 80% of traders anticipate one more 25 basis point rate hike from the Federal Reserve in their March 22nd meeting, and a pause after that to see what happens. According to the chief economist at ING, U.S. inflation data suggests easing price pressures. However, the Federal Reserve will be cautious in ending interest rate hikes as they don't want to trigger excessive spending and extended inflation. The peak federal funds rate that is currently priced in is 4.75 to 5%, but this will depend on the information received before the March 22nd meeting. The good news is that consumer expectations for near-term inflation have fallen to the lowest level since April 2021, which indicates the Fed's plans seem to be on track. However, rising unemployment is a topic to consider in the current situation. A significant number of jobs were lost in recent months, but some of these companies had hired a lot of employees in the past, which means they still have more employees than before the pandemic. These companies seem to have hired more people during good times and reduced the headcount during tough times, and they may cut more jobs in the future if necessary or monitor the situation. Employment has mostly returned to pre-pandemic levels and wage growth is near normal, indicating that it is no longer driving higher prices. However, there is a concern that the Fed may have to increase interest rates a little more due to increased demand, which could negatively impact the market. Additionally, investors are using cash in money market accounts, which pay over 4% and are considered relatively low risk compared to stocks or real estate. It remains uncertain how the situation with stocks will develop and whether a further decrease is necessary to encourage people to invest again. However, the trend seems to be heading towards the end of the rate hike cycle as England and Canada are expected to reduce their rates in the near future. Be sure to subscribe, and thanks for watching.